This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 25th. Some highlights from today's show. The April 2nd tariffs updated. US stocks are now outperforming and German Bunds are in play. Good day traders, and welcome to the Daily Market Rundown. Let's talk a little bit about what's gone on in the European session. Looking across, of course, at the start of Asia, it didn't really share in the enthusiastic rally we had in the US yesterday. If we then follow on and look how Europe is performing today, of course, it is bid. But if we actually have a look at the overall week performance, from the likes of the DAX, the CAC, and we compare that to the likes of the US, we can see there's a real underperformance, particularly in Asia, but also in Europe, relative to what we've seen in the US. Now that matters for context because it tells us that a lot of yesterday's rally in the US was perhaps quite a bit of short covering. Now with that in mind, let's actually talk a little bit about what ultimately drove a lot of that move in the markets yesterday. And it came, of course, in the form of an update regarding Trump's tariffs, and in particular around what to expect around the April 2nd. Now, again, it wasn't necessarily that it was market moving. There was nothing new to take away from it other than the fact that the tariffs that are going to come on the 2nd of April are perhaps going to be a little bit more limited, a little bit more targeted, and a little bit more expected than ultimately what the market was fearing, which is a worst case scenario, sort of a blanket type tariff. So the point is, and what we've seen over the course of the last couple of weeks, is that we get more and more information about these tariffs, and it feels, and the market's interpreting it as, we're getting these constant step backs in terms of what's actually coming down the pipeline. Okay, so at a rhetoric level, sure, it sounds aggressive, it sounds like, wow, end of the world type stuff. But in reality, what's actually being put in place is very limited. It's very targeted. And ultimately, it may not raise as much revenue as Trump is making it out to be. Now, of course, everything is still on the table, and we always have to be, ready for sort of some update. But right now, it does look like the April 2nd tariffs are going to be taken positively. We also had a little bit of an update in terms of Trump was announcing a tariff of 25% on anyone that imports, from the likes of Venezuela. And this ultimately is very much heavily leaning against China. Okay, they're a massive importer of Chinese oil. The Chinese are a massive importer of Venezuelan oil on the black market, and so ultimately this is something that'll hit China quite aggressively, perhaps also why Asia underperformed somewhat this morning. So that is the update. It's not that it was necessarily new news. It was just a market that was slowly grinding up. There were quite a few shorts in the market, and bam, the shorts have now been squeezed out of the market. Now with that in mind, then another news article to pay close attention to, because I think this is what's going to start to get market participants' attention. It's from Fed's Bostic. Now it's not necessarily what Fed's Bostic himself said his view is on in terms of the rate cuts. It's ultimately summarizing what the interpretation was from last week's Fed meeting. Okay, there was obviously a lot of back and front in terms of what the key message was from last week's Fed meeting, but I think the key message ultimately is that, look, cuts are not coming anytime soon, and if we are going to get cuts, they're going to come right at the end of the year, because we do need to fully understand the implications of the tariffs that are coming in place. Now, because obviously Trump is doing these tariffs in a very slow fashioned way, where they're really ultimately taking their time in terms of imposing any kind of tariffs, it is very much a case that these tariffs could drip feed their way into the market, drip feed their way into higher inflation, and ultimately that means the Fed has got no room to be cutting rates anytime soon, if at all this year. Okay, last week the key message from Powell was very much a case of, we're not actually sure if we can cut, when we can cut. We do, of course, want to maintain a view that we need to cut, particularly because of all the uncertainty surrounding the tariffs. Okay, and that was the key message, which is we're not going to cut anytime soon, and we're very uncertain, and that's why we think the next move will be a cut. Okay. Now that being said, what Fed's Bostic said is ultimately he told us that several officials had all kind of shifted their median dot. Okay, and I think that's really cool, key, because what he's leaning on is that there's quite a few participants at the Fed that are getting the same information from their business contacts, which is businesses in general in the US seemingly are going to be passing on the higher tariffs. Okay. And what that means ultimately is that the consumer is going to bear the brunt of it via higher prices. And the debate now, whether it's the president of the United States or whether it's Fed officials or whether it's economists, the debate is ultimately, is this going to have long-term implications for inflation, or is it a one-off? Now, nobody knows. That's the point. Nobody fully understands the implication of this, but we do know it will have an inflationary impact in the next 3 to 6 to 12 months. Okay, that is the point of all this, which is we are going to get higher inflation in the near term. And in that scenario, there's absolutely no way the Fed cuts. They cannot cut in a higher inflation environment unless, of course, the economy falls into recession. Now, why does that matter? Well, if we move on into a couple of charts time, I'm going to talk a little bit about the dollar and bond yields in general, and hopefully that'll start to shape the context of what to expect over the course of the next couple of weeks. But yeah, is that underperformance I just wanted to showcase. If you look at, of course, the US equities on the week to date, we can see it was very much led by tech. The FANG index was up 3.5% yesterday, Russell 2.5%, Nasdaq 2%, and the E-mini is 1.75%. So very much a tech-led rally, which we'd expect. Okay, Mag 7 got hit particularly hard, and it is the golden stocks ultimately of the US economy. So ultimately they've been bought back very aggressively yesterday. But like I said, were they bought back, or was it perhaps a bit of short covering, or perhaps a combination of both? I suspect a combination of both. We can see in Europe, of course, as of yesterday or the week to date, the European equities were down quite a bit yesterday. They've clawed that back in early Europe today, but we can see they're still very much underperforming the US, and that just shows us that it's all about the US indices rather than anything else that's going on around the world. Now, with that in mind, like I said, I think the key takeaway and the key thing to understand is that we're not getting any rate cuts anytime soon. And so this idea of, the US economy falling off a cliff, this idea of a US recession coming anytime soon, I don't think that is the case. I think that's very much Twitter land that has sort of forecast that idea. I think the idea of a recession now needs to be pushed back on a little bit. We are starting to see some good data return to the US. And ultimately what that means is the dollar short has now done its job. We've seen those trades put on. We've seen that effective squeeze take place, liquidation take place earlier this year. So I do suspect the dollar is now going to continue and stage its bounce. How high it bounced? Well, I think a lot of that will depend, of course, on the incoming data. But right now, I would not be wanting to be short the dollar. I do think this bounce continues, particularly like I said, because we are starting to see a little bit of rate cuts being pushed back up. Okay, and that's what this purple line is ultimately showing us. It is showing us as it starts to move back down, some of those rate cuts to the end of next year being pushed back out of the market. Okay, if we just sort of take a look at this chart, we've already seen almost 17 basis points come out of the pricing over the course of the last 2 and a bit weeks. Okay, so the markets are starting to turn a little bit more hawkish on the Fed, a little bit more of this understanding that no rate cuts are coming anytime soon. If they do come, they're coming later this year. And what that means is, of course, the dollar is now a very, very good buy. Now, with that in mind, what confirms this signal? Well, we've got to look at the yields, okay? And what I've got in front of you in the yellow is effectively US 10-year yields, okay? Now, what I want to showcase to you is two things. One, if we go back to last year and we look at when the slowdown began in US data, it started, of course, in Jan, February, March. We had those very much higher inflation prints, and we can see yields rallied. But then we started to see the slowing of the US economic data, which culminated, of course, in the August print. And that's where we saw those yields really drop from 450 all the way down to almost 350. Call it 100 basis points drop. That was this fear of an economic slowdown, the fear of a recession coming to the US economy imminently. Okay, fast forward, of course, that low point was made when the Fed cut 50 basis points. They panicked cut. Ultimately, we rallied all the way back up towards 4.8%. But if we go and look at the start of this year, okay, this is effectively the point when we started to see the US slowdown occur. We're starting to see concerns around uncertainty around the tariffs. And look what 10-year yields did. They dropped from around 450 to around 425. Call it 25 basis points cut. Now, compare that 25 basis point cut to that 100 basis point cut. Okay, two very, very different scenarios. More importantly, we've already started to see these 10-year yields now start to bounce. And guess what? They're bounced off of that 200 moving average in the purple line. Okay. In other words, if this was a growth slowdown, if there was a fear of recession, if there was, in fact, this real concern that the US economy is actually slowing, the Fed would need to cut, these yields would have dropped a lot closer to that 360. Okay, the fact that they've stopped around that 425 mark and are now starting to stage a bid again should worry anyone that's long bonds, of course, but ultimately anyone that's looking to be short dollar. Okay, the fact that these yields are still sitting very elevated ultimately tells us the US economy is still the strong economy. It's still set to grow robust this year, and you do not want to be turning into some sort of a recession person on the US economy. Not yet. Okay, the data doesn't justify it, and more importantly, the yields do not justify it. Okay, path of least resistance ultimately is going to be back up towards this 4.7, and that's important because we will at some point be talking a little bit later this year about the implications of that. Okay, keep in mind in the second half of this year, the US economy has got, or the US Treasury has got a significant amount of issuance coming down the pipeline, and I'm pretty sure they don't want to be issuing at 4.5-5% yields. Okay, the reality is there are going to be implications of these higher yields, but right now the only implications is with higher yields, you're going to get a stronger dollar, you're going to get a US stock market that's going to be performing well. Okay. Now, with that in mind, before we get over to the S&P 500 chart, just talking a little bit about the Bund. A very good technical pattern, what we call a Larry day. It's effectively where the market opens up on the high of the day and technically should close on the low of the day. Right now, as of moving into the US session, German Bunds are a little bit oversold on the day. They have reached their sort of their 20-day ATR in terms of range. However, Larry days, all rules are off the book, and we should see this continue to drift lower over the course of the US session. So keep a close eye on that. Bund is very much in play. It's very much a sell-only market. We could see we did make that series of higher highs. I suspect now we're going to make that little bit of a higher low. Where that comes in, I don't know. Perhaps somewhere around 126.70, 126.80, somewhere around there. The point is that Bund should come in now and test and find that little bit of higher support before it rotates higher. Okay, it's very much a market that's now consolidating in this range, and so now that we've rejected that higher range and come back inside that 128.30, we should make our way back down towards the bottom. Okay, the fact that we're getting that price action and that Larry day today confirms this play, and that's why I think you probably got about another 80 to 100 ticks to the downside in the near term, today/tomorrow. And then finally, of course, S&P 500. Now, this is an important chart, and there's two things to pay attention to. The sentiment in the market last week was poor. The sentiment in the market this week is positive. And the most important thing to understand, and I've seen this many, many times in my career, is that typically what we do as traders is we go, well, I try to sell it all the way down, ultimately didn't get paid much for it. It was quite a difficult sell-off. Tried to buy it down here and started to fade. It didn't make any money, of course. And in reality, what we do now is we're starting to look for shorts. Okay, this is what you'll see all the technical analysis out there saying, oh, look for shorts around this 58.60, it's key support, blah, 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 blah. The reality is they're missing out on the most important technical indicator, which is this thing in purple. Okay, that is the VIX, and with the red line is ultimately just a moving average of the VIX. Okay, now what this ultimately is pointing to, the VIX is currently back around that 18 mark, but it's almost back in towards that January range. Okay, so if that VIX does drop in around that 17 level or even below, guess what? This level of resistance isn't going to hold. If anything, this market's going to very quickly make its way back up to that 6,200. Okay, the VIX being squashed like this is a very technical bullish indicator. Moreover, we've got a very good gap that held yesterday. Okay, we gapped, we opened, and we rallied. All right, very, very important technically as we've got a gap up yesterday. The VIX is getting squashed. 58.60 now is pretty much a line where if we get back above it, you only want to be a buyer of the market. Okay, now I appreciate many of you look at this chart, you go, yes, but it's pulled back to this level and to this level and that level. The reality is that, keep in mind, everyone on Wall Street is talking about double-digit returns this year. Very few people, very few economists or forecasters have adjusted their expectation for US indices this year. Okay, almost everyone on Wall Street is talking around a 10% up year for S&P 500. Should we get above that 58.60, it's just going to drive more FOMO into the market. Okay, so keep a close eye on that. I do suspect we scale that 58.60 today. I do suspect it gets tested today. I do suspect we close above there, and we are going to make our way very quickly back up towards those record highs in the near term. Now, of course, all of this is dependent on the data, and we will be getting that data coming in thick and fast. Of course, next week we've got month end, but then we also have the non-farm payrolls. Okay, the point is, if we get a non-farm payrolls that's pretty strong next week, don't be surprised to see us trading back around that 6,000 mark and higher. Okay, what I want to stress here is that it's a case of you've got to be nimble. Okay, get it out of the idea that the US economy is going into recession. Fine, it felt like that last week, and that was perhaps the right mindset to have. But the reality is things are turning, and right now price action is telling us that VIX is getting squashed, which means equities are going to continue to the upside. Now, with that in mind, in terms of the economic data, there's not a great deal actually in terms of data for the rest of this week. We have got the PC out later on this week. But besides that, it's very much going to be the technical flows. We did, of course, have the OPEX last week. We've got now both the US and Europe trading in the June contracts. So we are back to more technical markets. We are back to markets now that'll start to respect the levels. And that means that we can fully engage into these markets. With that in mind, if there are any other questions, do post them in the Discord channel. Otherwise, as always, manage at risk. Good luck out there. Go make some money.